Here to share what he's seeing in the rental and market and the housing sector overall is Dallas Tanner, CEO of Invitation Homes, which operates over 100,000 single-family homes. It's great to have you on. You announced last week that you're going to be providing professional management services to portfolio owners. What struck me about this is the fact that we know inventory is incredibly tight in the housing market in this country right now. How does that speak to broader housing market dynamics and what you're expecting in 2024?
Well, the broader housing dynamics are really interesting because supply still continues to be the villain in U.S. housing. Well, there are definitely professional operators in the space, one of which we announced the transaction with Starwood this week. We can certainly leverage our expertise and the size of our platform to drive a better customer experience for those professional, owners that are out there in the marketplace. I think the dynamics going into 2024, candidly, feel pretty out of balance. We need more supply in the U.S. from a housing perspective. We certainly need smart operators in the space that can continue to drive both affordability and flexibility for the customer, because at the end of the day, it's all about choice. And I think customers out there want choice, they want flexibility, and they want to maximize whatever they can pay, whether it be a mortgage or for rent, to get the highest and greatest value out of that payment.
What are your expectations for rent prices this year? I mean, investors and even some Fed officials have basically said and baked in expectations that we're going to see a resetting in rent prices, and those are going to be under pressure. Do you see it the same way?
Well, it's certainly come down from the historic highs like in October of say, 22. What we are seeing is that the propensity to renew with our customer is far stronger than what we'd seen in the past. And again, we haven't reported our fourth quarter, but what we saw going into summer was that there was definitely a desire to renew and to renew at pricing that was pretty favorable from our perspective. I think you will definitely see it come back to more, what we would call norms going into 24 and probably 25. But the single family resident is very sticky. Our customers today are staying with us in some markets well into their fourth and fifth year. So we're doing something right as an organization and as a company, but it's our goal to continue to make that experience so sticky that it's often much more favorable to lease than it would be to own. And then you have the factor of just cost and mortgage costs today. Our customers on average are spending about $1,000 less a month than they would be if they owned. And so those dynamics you talked about earlier, Morgan, are very real. And I think people are shopping and they're trying to make sure they get the most value out of their spend.
Dallas, you mentioned the lack of supply out there as a problem, but isn't that helping you? I mean, it would seem to be part of what's taken your average length of stay up to 3 years if people can't find a place to buy.
Yes, supply is certainly the problem, and there's no doubt. And look, we're using our balance sheet to build more product today. We're actually competing against ourselves. We delivered just under 700 homes last year. We have about close to 2,000 homes in our pipeline today of new homes that we're building, and we're continually looking for these opportunities. I think what you have to balance out, though, is the fact that mortgage origination has been so expensive, and then that lock-in effect is also, creating less flexibility and transaction volume, which ultimately has sort of an impact on what people do and the types of decisions they make, whether to stay or not.
Okay.
I think the biggest issue all around is affordability. It's just very expensive to move, and there aren't a lot of options right now.
To that point, you sold 397 homes late last year, turned around and bought 387 in Q3. Does that mean the rents on those later homes are higher, and that's why it's good for you?
So in the resale market, for the last several years, we've actually been a net seller. To your point, John, we continually sell homes back into the marketplace, and then we're investing in building and creating new product. We see that as a continued opportunity for our business. We'll continue to look for ways to sell homes back into the end user market while we recycle our capital really into newer construction product that we're building. I think the market itself needs more of that resale supply to come in. Most people haven't paid attention to this number, but resale supply was actually up a little bit in the last quarter, somewhere around 3.5 months. 3.5 months of supply. Most economists would probably tell you we need somewhere between 4.5 and 5 months to have a normal resale supply market.